So thank you everyone and by the way, yeah, thank you everyone for coming to today's talk. And before Yasmeen gets started on her talk, I'd like to repeat the disclaimer one more time. So this talk is by the speaker and it's owned solely by the speaker. And the PDA does not endorse and are not responsible for the comments or this talk made by the speaker. And this talk is should be about financial education and financial literacy, and not any specific financial advice. All right, so with that out of the way, Yasmeen, please take it away. Thank you.
All right, thank you so much. I appreciate that. Thank you so much for the invitation. Wow, it seemed like so long ago when I first got this invitation, but I'm gonna go ahead and share my screen so we can get started. And if you wouldn't mind holding questions to the end, that would be great. And we'll go from there. Okay, all right. So going back to the first one, this is Financial Empowerment Foundations for Postdocs. I am Dr. Yasmeen Nkrumah-Elie, former postdoc with many of you, the founder and lead consultant for Health and Wealth with Dr. Yaz, as well as the Financial Empowerment Educators. So I also have my own disclaimer. And so I am not a certified financial advisor, though I'm providing information that has been approved by financial advisors. I'm going to be talking about different types of systems that have worked for me as well as many others. I cannot recommend any specific stocks, mutual funds, or other investment vehicles, and it's highly recommended that you seek a professional for this type of information. This is financial empowerment education, and I will provide you with valuable information so that you can make educated decisions for yourself. Also, I am employed by someone in addition to having a business, and this does not reflect the views of my employer, our board of directors, nor our investors. So let's talk about my story. I went through the education process and became a postdoc. Wow, that's pretty awesome, right? So finished my PhD and started postdoctoral work. And with that, after about a year, I got taxes due, and I was like, wait a minute. At the time, I think I was making less than $40,000 a year. And now all of a sudden I owed taxes. And at this particular institution that I was in, they didn't actually withdraw taxes from our check every month. So now I'm with this big tax bill and I'm like, I don't even know what to do. This is crazy. I'm so confused. Now I owe all this money. And I really felt like I was already broke and didn't have enough money at the time. And so on social media, I saw someone post something saying, "Are you financially illiterate?" And I'm like, yes, I am. And so that led to a really amazing conversation that transformed my life. And I got introduced to a company called My Econ, where I started to learn a whole lot more about financial illiteracy and how it was costing me a significant amount of money. So from there, even though I hadn't gotten myself to being to that position of being a multi-millionaire, still not quite there yet, but I wanted to make sure that others were aware of this information, and truly being the type of person that wants to give back to others. I said, you know what? I want to make sure that others are educated and are not in the same kind of situation that I am in. And so I started a group called the Financial Empowerment Educators, where we are throughout the country making sure that we provide workshops more often than not for free to different individuals so that they can get financial education foundations. So I had to start asking myself a lot of questions, and I imagine many of you are asking these same types of questions when you start thinking about your finances. What is your level of debt? What is my actual monthly budget? What is my take-home pay versus what am I getting, after taxes are taken out, or before taxes are taken out rather? Where actually is my money going? A lot of it goes to food for me. How did I actually get here into this situation? So for me, when I was in graduate school, when I started graduate school, I had no debt. So I had no loans when I was an undergrad. And then me and my husband, who was also working on his PhD, I got pregnant. I mean, we didn't technically get pregnant, but I got pregnant. And so from there, at the institution that I was at, our student stipend was extremely low. We were not allowed to work in order to receive the student stipend. And so now I was in this really stuck situation. And so I kind of asked for some advice, and pretty much everyone said, just take out some student loans. It's very likely that you'll work for the federal government or something like that afterwards, and you will be able to get your student loans paid back. Now, this was pre-2008. So for a lot of people, that was the situation. I graduated after 2008, so that wasn't my situation. But I took out student loans so I could take care of health insurance, which I didn't have at the time. So, and then later being able to take care of childcare, transportation, even having to have a larger home. And so now I was stuck with this amount of debt. And then there was the credit card debt. And so I was in a mountain of debt, not quite knowing what to do and how to get out of this position because it was just piling up. So then I had to say, how can I change the financial trajectory of my family? My parents were entrepreneurs, but never talked to us about financial literacy. And I wanted to make sure that my children weren't in the same situation that I was in. I also wanted to know how long it was going to take me to get out of debt on my current path. And for me, when I started to calculate that, that was over 30 years. And I said, that is a chain that I don't want to carry. So what can I do to get there faster? And then at the same time, how can I help others along the way? So for us today, our goals are really to start learning how to manage our personal finances. I hope that everyone is actually going to learn something from this talk today, or at least reinforce something you have learned in the past, and providing you with an introduction to financial literacy that can help you with your financial success. I want you to recognize your own personal value. Sometimes as postdocs, we feel like we are just a half an inch from the bottom of the barrel when it comes down to our environment, but we really are truly valuable to ourselves, our families, and society. Also want to provide you with some different resources that you can use for your success and figure out how you can maximize your postdoc income to build wealth and reduce debt. So now it's time for you to become the CFO of your finances. So what is the problem? It's estimated that about 95% of Americans are financially stressed in some form or fashion, whether that's living check to check, not actually having $3,000 to $5,000 in an emergency fund per person in your family, not having 6 to 12 months of living expenses, and recognizing that the average American family debt is about $72,000. Most Americans have insufficient retirement funds. I mean, when I started my postdoc, I was not thinking about retirement. I was thinking about how to finish my postdoc. But we really don't have financial success plans that can help us. And unfortunately, it is this lack of money that is keeping us from personal financial freedom and fulfillment. So a study that was conducted by NerdWallet started to analyze Americans, and this is a few years back, to figure out how much debt we actually had. And one of the challenges was that many Americans actually didn't recognize their level of debt and what it meant. So you could ask most Americans, how much debt do you have? And they can tell you what it was today, but they weren't actually predicting what that was going to cost them over time. And if they were paying the minimum balance or even just a little bit over, how their debt was increasing over time. So what we have to realize is that we need a mindset shift. If you are all familiar, or maybe you're not, with Robert Kiyosaki, and he really transformed the world when he introduced his book, Rich Dad, Poor Dad. And one of the ideas behind that was that he had two different dads. He had a poor dad who was his biological father, who like us had a PhD, who was definitely working the 40-40-40 life, meaning that he was, working for 40 years, and then he was planning to live off of 40% of his income and doing that for 40 hours a week, right? So his poor dad would often say, I'm broke, or I can't afford it. Now, his rich dad was his friend's dad and was a mentor, who was someone who wasn't actually really educated. And he taught him to say, how can I afford something? So when you say, I can't afford it, or I can't do something, then your brain actually stops. It stops functioning. But when you say, how can I, just like when we're in the lab saying, how can I fix this problem? Or how can, in my case, get these cells to grow or these metabolites to make sense? Then your mind actually gets really activated and you start to think. So from where we are, we actually have to change our minds about wealth and what it actually looks like while we're obtaining it. So I have an example here about two different individuals. So person A, we're going to say, is a millionaire. They make $1 million a year. They have a nice home. They have cars that are valued at just, $1.2 million. That's costing them about $400,000 a year. They rent jets to get from point A to B. So let's think about the Beyonce, Jay-Z lifestyle, but not someone who has the Beyonce and Jay-Z income. They spend money on jewelry and clothing, but you know what? They're not selfish. They actually give money as well. Then there's person B. Person B makes about $60,000 a year. Hopefully, many of you are person B. You might live in a $240,000 home. It's kind of hard to find in Colorado. That costs about $18,000 a year, has a car that's not new, valued at about $18,000, spends a little bit on clothing and jewelry, spends a little bit on travel and fun throughout the year, and you know what, still is a good person and gives back to charity. So when we say who is rich and who is wealthy, person A is rich, but person B is actually the one that is wealthy. So person A has an income of $1 million a year, but has 1.6 million in expenditures. So actually they're in debt $600,000 a year, so they're broke. However, person B is only spending, about $34,000, almost $35,000 a year, and thus they're actually wealthy because they have more money than they have debt. So what keeps people from being wealthy? There are, in general, 4 primary challenges that are impacting our finances. And these are kind of some of those secrets that we don't really think about. Inflation. Inflation is how the cost of goods and services increases over time. I have the perfect example. Just yesterday, I was dealing with my benefits, and the cost of our health insurance for my particular company is increasing by 16% from last year. That is inflation. So it's how the cost of goods and services are going up, but our income is often flatlined. Taxes is another big challenge, recognizing that we're putting about 25 to 30% of our income, and sometimes even more, towards taxes. And when we get our salary and it says $60,000, we're thinking, I'm bringing home $60,000. No, you might be bringing home closer to $48,000. But when you fill out an application for a car or a home, you put down $60,000. But again, that's not how much money you're really bringing home. And so you start to have this deficit in your income. Debt is another huge challenge because we are facing more debt in America than ever before. I mean, when we look at student loan debts being in the trillions, it's just like, wow, this is a ball and chain that keeps us from really getting to success. And our debt is unfortunately increasing over time because, especially like in places like Colorado, the cost of living is increasing even more. So whereas about 10 to 15 years ago, you could get a house here for $300,000, that same house now is closer to $450,000 to $500,000, which puts you in debt for a longer period of time. And then the other challenge is big business. Now, I'm all for the good aspects of capitalism, and I understand that everyone should be making a profit, and the point of a business is to make money. But big business has a way of actually being able to manipulate us to spend. I mean, first of all, let's think about holidays. In January, we have New Year's Day. We're possibly spending a little bit of money, or we have a New Year's resolution. So now we're spending money at a gym or weight loss services or stop smoking or you name it. Then by February, we have Valentine's Day. I mean, we tie our emotions and our feelings into material goods. So if I love you, I'm going to buy you a gift. If you love me, you're going to buy me a gift. Now, the concept of love is amazing, but why do we have to commercialize it? We get into March and we're dealing with St. Patrick's Day. We're getting into April for those that celebrate. It's Easter time or it's spring, and now you're getting new clothes, particularly if your kids' mind won't stop growing. So you have to, you're getting these new wardrobes. By May, we love our mothers. We have to get them gifts. I mean, that's coming up right around the corner. By June, we're dealing with Father's Day. We're also dealing with graduations during that period of time. July, this is the best time to blow up money. I mean, you have to go buy the fireworks, right, to really show that you're a patriot, and then you're literally blowing it up. By August, we're dealing with back to school time. September, we have Labor Day, and oh my gosh, it's the last time to barbecue and get together for the season. I mean, we're dealing with COVID, so it's a little bit different, but I mean, I'm imagining this year in September, we're going to have lots of people wanting to have barbecues and get-togethers. And hey, you got to have that, right? Have those times and lots of food, lots of drinks, and we're celebrating together, but it's also costing us money. October, wow. It is the second largest holiday in the United States, Halloween. It's fun, but we're spending a lot of money on decorations, on costumes, on candy, on treats, sometimes even parties. November, it's a time to be thankful, absolutely, but we're also spending a lot of money as it relates to Thanksgiving. And then there's Black Friday. Well, now there's Brown Thursday. And then there's Cyber Monday, all of these holidays so that we're spending money. And then December, we end it all off and we make sure that big business makes even more money by indicating that our love and our spiritual reasons should include some sort of expenses, such as Christmas gifts, Kwanzaa gifts, Hanukkah gifts. I haven't really seen a winter solstice celebration. Maybe I should start celebrating. So there's some additional wealth challenges. One is low cash flow. So that's when you actually have more expenses or more bills than money. There's also the social pressures to buy, to keep up with the Joneses. So-and-so got a new car, maybe I should also get a new car. Or so-and-so was going on a vacation with their family, I should also do the same, even though you might not actually have the money to do it. We unfortunately have a mentality of consumerism versus a wealth mentality, wanting to keep and save more of our money, and financial illiteracy. Most of the country really doesn't understand money and how it works. So when we think about it, Warren Buffett is one of the wealthiest people in the world, but yet his tax rate is lower than his secretaries. Robert Kiyosaki talked to us about the different types of brackets. So there's the 4 quadrants for those who are employed, where you are exchanging your time for money, and you don't really get paid completely like you want to. Then there's the self-employed who really own a business. Then there's those who actually have a B, which is a B for business, and you're letting your money work for you. And then there's the investors. The investors are taxed at the lowest rate, and their money is starting to build more and more. They are actually making money while they sleep. So the idea is you want to be able to move from only being in the E and S into the B and I. But if you just started and you're an employee, it might take a few steps before you get there, but we're going to work on that. So with all of these challenges, what is a solution? And one solution is called income shifting. The idea behind income shifting is that you are shifting your money towards building increased cash flow. So there are several different strategies for income shifting. One is to be able to correct your tax withholding. So nearly 8 out of 10 US taxpayers actually get some sort of refund. If you're getting a refund, that means you paid too much. Think about that. Some of us use it as like a forced savings, but if we're getting a refund around this time of year, then that means you paid too much in your taxes. And why is this happening? Well, when you filled out your W-4 form, it's actually your employee's withholding certificate. Now, our human resources and everything else cannot help us fill this out. We are supposed to understand the legalese and technical information for it. And many times it's filled out incorrectly. And when I say many, I mean 80% of the time, because people are getting a refund. So this is a form so that your employer knows how much money to withhold from your pay. And if it's filled out incorrectly, again, you're paying too much. So the purpose is to complete the Form W-4 so that your employer can withhold the correct federal income tax from your pay. And you should consider completing a new W-4 form every year or when your personal or financial situation changes. Every year or when your situation changes. So you actually can help reduce your taxes by correcting your W-4 form. Now this was from 16 years ago, but recognizing that where does your refund actually come from? It comes from you, your money that you're supposed to be earning. So for the average refund, and this was 16 years ago, it was about $40 too much. And the IRS was letting us know this. Some people use it as a savings account. So then when it's, this time of year rolls around, then they get a big check and they might pay off debts from the holidays or things like that. But really, if you had that money in your pocket every single paycheck, think about how you could actually reduce your debt. So the next one is actually building great credit. So hopefully everyone on this call is aware of their credit score. I'm not going to ask anyone to raise their hands and let me know, but you want to make sure that you understand your credit and where credit comes from and how it is built. So Lexington Law actually created this nice slide that I'm utilizing here in terms of ways that you can improve your credit score. Now, an 850 is basically perfect, but you want to look and see how can you get into around the 700s, 750, 725, so that you're actually building up your credit. And the reason why this is important is because when you receive loans, car loans, mortgages, you're actually getting a lower rate that indicates that you are more responsible with your money. So someone who has, for example, a 550 credit score might get an 18 to 20% interest rate on their vehicle, whereas somebody who has like a 750 credit score may get a 3 to 4% interest rate on their vehicle. So when it comes around, the more responsible you are, the higher your credit rate is, your credit score, then the less money you're actually having to pay for these different expenses. So ways that you can improve your credit score, including pay more frequently, pay your bills on time, pay back all of your debts. If you can pay them back in the month that you receive them, that's phenomenal. If you're not quite to that point, you want to make sure that you're paying more than the minimal. You want to lower your utilization percentage. So there's a lot of different great resources that are out there that'll let you know how much of your credit you're actually using. So you want to keep that under 30% if possible. You can also increase your credit limit. There's various techniques and ways to be able to do this. You can write or call your different companies and ask for them to increase your rate or find out what they would want to do based on their algorithms so that you could increase your credit limit. You want to be able to remove any negative entries that are on your credit. So if you have any older debts that are there, you also can technically get your student loans removed off of your credit report. You can also get medical information removed off of your credit report because it can, in some cases, violate HIPAA. And you also want to keep unused credit cards. Now, this was something that I didn't know. When I was 18 years old, I went to a particular party and got very wet and needed a t-shirt. And when I was outside, I was like, wow, there's this whole credit card thing that's sitting next there. I wasn't thinking about that. I was thinking about, I need a t-shirt. So filled out the form so that I could get this particular type of credit card, really to get the t-shirt, got the card in the mail and was like, oh, now I have this balance of a certain amount of money. I'll start spending this. So I did. Was not financially literate, got to the point where now I'm getting negative letters. You haven't sent your minimum payment. I was a, undergraduate student. I wasn't getting monthly income. I was really worried. So finally got some money, paid it all off, closed the card. And so that was really unfortunate because I stopped some of my credit history based on doing that. A resource that you can use is My Credit System. There's others that are available. If you need help with repairing your credit, I recommend that you start with yourself first. We're all educated and we can learn through the My Credit System and other systems that are out there. They're financial education systems, so it teaches you how to repair your credit yourself, or at least the foundations. And if there's more challenging things that are available, then you would be able to look at other ways in terms of having some other types of services. So then our next one is eliminating debt. This can seem like an elephant in the room. But first, you actually want to start saving. So some of what you earn is yours to keep. For some, that might be a revolutionary thought. Wait a minute, some of the money that I earn is actually mine to keep. It is recommended that you pay yourself at least 10% per check. Now, I understand if your debt is super high and your expenses are super high, then looking at that number can really seem like a daunting task, but I think you can do it. And as you're saving, you want to have a small emergency fund of $3,000 to $5,000 per person in your family. How you can actually calculate this is to assume the worst. I don't recommend that, but assume the worst. Let's just say that unfortunately a tornado comes, tears through the property that you're living in, tears through your car, and also you and all of your family members have to go to the hospital. Would you be able to pay your deductibles and minimums for that? So that's actually how you count. You would count your deductible for your mortgage or your renter's insurance, your car insurance, and your deductibles related to your health insurance. And that'll give you the exact amount that you actually need to have in your small emergency fund. Your major emergency fund is 6 to 12 months of living expenses. So the reason that you have this is if you lose a job, or if something happens and you're actually disabled. Now, for some, there are long-term benefits that you can get through your health insurance, and that usually actually kicks in about 6 months. So unless you have some sort of way to supplement your income during that period of time, you could be in a difficult situation. And I'm not going to get into insurance very much, but you want to make sure you insure your number one asset, and that is you. So there's lots of different ways that you can actually cut down your monthly expenses, and I'm not going to go into all of them, but the idea of the latte fund is that a latte is a nice to have. It's nice to go to Starbucks or to other businesses and get that 7, 8, my cousin spends $9 a day on this latte. You can actually cut those expenses significantly by just making your own coffee. You can be creative in terms of how you can cut your expenses, but look at what you're spending every single month and say, is this necessary? And what are the alternatives to help me save more money? So write down all of your expenses down to the penny. Be a penny pincher here. Cut away some of these unnecessary expenses. You can figure out how to cycle or walk to work. That's really nice, especially if you're near campus. Shopping at thrift stores. I can't say that that is my personal preference. Buying unbranded items at the grocery store. Taking your own lunch to work so that you're not actually having to buy it all of the time, though we do love e-ties. Bulk cook your own meals so that you're actually saving money on your food. You want to look at your gas, electric, and other utilities. For example, where I'm at, your trash. It's a competitive system, so you can look and see where you can save in some of these different places, or maybe just turn down your heat or your air conditioning so that you're saving a little bit every single month. Cutting out pricey alcoholic drinks, or I don't know if what is it, the AIA, so the Academic Industry Alliance. Go to those events and have them pay for your drinks. Keep a change collection. And there's many other ways that are offered on some different websites. So then once you actually start saving this money, what should you do with it? Well, we're talking about debt elimination here. So in this particular example, we're going to take $850 of monthly additional cash flow. So $300 from correcting our W-4 and $550 from cutting unnecessary expenses that we just talked about. So for this particular example, we have different debts. We're just making this simple. We have two credit cards, a car, and a mortgage. So for your credit card, let's say there's a $4,000 balance. You're paying $125 a month. Now you take that $120, this $850 that you found from saving money and correcting your W-4, you now have a new payment of $975. So now it's actually only going to take you 6 months so again, this is an example, to eliminate that debt versus 48 months. So the cash available after that elimination is $975. We're going to snowball this into our next debt, which is our credit card number 2, $5,000 balance, again, 4 years to pay off. Current payment is $150. We take that $975, add it to the $150. Now we have $1,125, takes us 5 months to eliminate. Take that $1,125, put it into the next debt. So now with our car, we're going to be paying $625 or $1,625, 13 months to eliminate. Then we're taking that money and putting it into the mortgage. And versus having a 30-year period of time to pay off our mortgage, now we're having 106 months to pay that off. And then at the end, we have $3,425. Now, of course, this is an example, but this is the snowball method. Another debt elimination strategy is called the avalanche method. And where this one is looking at the lowest debt first and gives you that feel-good feeling once you get it done, the avalanche method is one in which you tackle your highest interest rate first, and then you categorize after that. So whatever method you try, and there's probably a few others that are out there, just make sure that you are being consistent. So for this particular example, the total debt eliminated was $389,000. It took 10 years and 9 months versus 30 years. The amount of money that was saved in interest payments was over $350,000. And then this individual is now cash flowed or now has extra income for investing or monthly lifestyle of over $3,400. So next, we want to minimize our taxes using positive cash flow management. So here we're going to talk about assets versus liabilities. An asset is something that makes you money or helps save you money, whereas our liabilities are those that take our money. So one of the best ways to actually start saving money is to start a home-based business. So some of my suggestions are to become a consultant. We can consult in the areas that we are experts. Now, sometimes as a PhD and as a postdoc, we forget that we are actually experts and that we have valuable information that we can share with others. Being a consultant is flexible. You can do it on weekends or nights, or you can schedule particular times, even when your schedule gets busy within the lab. You can charge what you're worth, which when I was a postdoc, I didn't realize just how valuable I was. And you can start to build your clientele slowly but surely. The IRS indicates that for a business, you need to be attempting to make a profit. You need to keep business records, and you need to be consistent. Now, consistency for the IRS is generally about 5 hours per week. And also for 1 to 2 years, you could be learning more about that business through different educational resources and tools. You could also become an independent associate of a current company that's already established, which often will have some low startup costs and sometimes plans that are actually set for you for success. You can teach yourself skills for business and management. And you can also get tax deductions just by having this home-based business. I'm going to show you some examples on the next few slides. So, what can you turn from a liability into an asset? So if you have a car, it's a liability. But if it's a business expense, it's an asset. Same thing with your rent and mortgage. It's a liability until you technically have paid off your house. But if you have a home-based business, then that space that you use for your business is tax deductible. Credit cards move now towards business loans, where you actually are able to deduct your interest rates. Savings accounts that have an interest rate that's less than the inflation rate, which is most of them. So if our inflation is about 3% to 5% per year, but most of our savings account, we get excited when we see 1%, right? But now you're moving that towards investments. If you have a cell phone, it now becomes a business phone, where again, that's tax deductible. And your spouse and children, well, you don't have to give your children allowance if you hire them, because now they become your employees, and you will complete 1099s for them, which again is tax deductible. And then if you're going on vacation, now if your family is employed by you, you're taking a business trip with your employees. And then there's other expenses that you can turn into business expenses. So this is just kind of an example of how this could work. This is example purposes only. And so let's say, for example, you're paying $2,000 a month for your home. You designate 20% of your home to be for your business. Now that's tax deductible, and that's $400 of monthly savings that you would get from your taxes. So that's $4,800 per year. For that same space, those utilities become tax deductible. So you might be paying $500 a month. That's $100 of monthly savings, $1,200 per year. Your internet would be 100% tax deductible, similar to if you go to a Starbucks or a McDonald's or some other businesses that have free Wi-Fi. Again, it's 100% tax deductible, so about $600 a year for this example. Your cell phone, if it is your only phone, then you would probably limit it to about 80% as it relates to your business, and that would give you a monthly savings of $80 and $960 per year. Travel and lodging, just gave you the example of versus you going on a vacation. Now you and your employees are going on a business trip, so saving about $4,000 in this example. $15,000 a year in car miles at the tax deductible rate for businesses, which is 56 cents per mile. It actually went down from last year of 57 cents. Then you have a monthly savings of about, let's say we're doing 10,000 business miles per year, not per month, but that's saving you $5,600. And you've hired your children. Now, hiring your children, we can talk about that later, and I actually have something on YouTube about it, versus paying them, for doing chores and things like that. You're now actually hiring them to do similar types of activities for your business. And so let's say $500 a month, 100% of that is going to be tax deductible as long as you've done the paperwork and you've hired them legally and correctly. Monthly savings of $500, $6,000 a year. So now you have shifted your income by $20,600 per year. And there's over 450 different types of deductions that you possibly could qualify for as being a home-based business owner. So I'm going to give you an example. So let's just say you earn $60,000 per year. At a 25% tax rate, in theory, that would be about $15,000 that you would owe in taxes. Well, luckily, our government doesn't take all of that. So these numbers fluctuate a little bit, but we're going to say about $12,000 per year. They actually reduce from that. So you really end up paying on $48,000, but again, at about a same tax rate of about 25%, which would be $12,000 per year. And more often not, you're seeing that come actually out of your check. But taking the example that I just previously had of $20,600, you would deduct that from your $48,000. So now your taxable income has gone from $48,000 to $27,400. Now at this rate, your tax rate actually would lower. Again, this is for example purposes only. So it would be about 15% now. And so 15% of that 20,400 is going to be $4,110. So when you subtract that 12,000, or rather you subtract that 4,110 from your $12,000, you've actually saved $7,890 in federal taxes just by having a home-based business and shifting those liabilities into the asset category. So then our last section is investments and investment education. And again, I cannot give you any financial advice as it relates to investments other than making sure that you are educated. So there's lots of different investments that you can build to receive passive as well as residual income. Now, I'll give you guys some fun fact about me. I was a child actress, and when I was 9 years old, I was on a television show. And for that particular television show, even though I'm now in my 40s, anytime that show is seen anywhere in the world or gets picked up by a network like Hulu or Netflix, I actually get paid from that. So even though I did work once, I now get residual income and have for, I'll date myself, over 30 years. So residual income is often where you do the work once and then you get paid for it over and over again. And passive income is income that is just coming to you without you having to do the work. So forms of passive income, and there are others, but these are just for examples, include stocks, bonds, mutual funds, real estate, and businesses. Warren Buffett has indicated that if you don't find a way to make money while you sleep, you will work until you die. And the best investment you will ever make is an investment in yourself. So when we think about, I need to start saving money, I need to start planning for my future, often we don't necessarily think about retirement until we hit, like me, 40s. But you want to start thinking about your retirement as early as possible. I mean, I have 2 kids that are on here, but technically if you hire your children, you can start paying into their retirement as well, building a Roth IRA, for example, which then reduces taxable income even more, but we can talk about that later or offline. So retirement options are offered at UC Denver and for the UC Denver Postdocs, but there is no matching. So for different companies and different businesses, there may be matching. If you were technically an employee, then it's quite possible that you could receive matching funds. And what does that mean? That you may put 5%, let's say, of your income towards your retirement plan, whether it's a 403B or a 401k. All of these are just different terms in terms of how they are really taxed and what those retirement benefits look like. So you could put money in towards that, and if it's matched and you put 5% and your employer has an equal match, then they would also put 5%. So that's a way to actually start building that up, and you're literally doubling your money. So if match is something that is available for you, you always want to match. So there are some other options. A Roth IRA, there's lots of different financial companies, and typically it takes about $1,000 to start. Some of them may be as much as $2,500, but you've been saving. Now let's start planning for our retirement. They often have a minimum monthly contribution, which might be about $100, but again, every company is a little bit different. There's a maximum annual contribution limit. So for your Roth IRA, it's a little bit over $6,000, but you want to double check those numbers. The money is taxed as it goes in versus as it goes out. So I'd rather be taxed a little bit while it goes in than when it comes out and is taxed at a much higher rate and a much larger amount. There's some sort of withdrawal principle as it relates to your contribution without penalties. And so you can deduct money from your Roth IRA that you put in, but not any money that has built interest. And if you start tapping into the income that your contributions actually generated, you will have to pay taxes from that withdrawal, particularly if you reach before the age of 59 and a half, when you can technically start withdrawing without having to pay additional taxes or penalties. So another type of retirement plan would be some sort of investment account, so like a taxable brokerage account. Typically, those are going to be starting around that $2,500 range as well. So when we start thinking about retirement, we want to know how much money do you actually need to have in savings, right? So most people in this country right now are retiring between the ages of 63 and 67. And when we first started looking at retirement, the length that we were living was significantly shorter. So it was really interesting that you could start getting your retirement at 65, but the average lifespan was about 63 to 64 years old at the time. So there wasn't really a plan when we were doing these pensions that we were going to keep living as long as we are, right? So now we might want to retire at 65, but we might live till 85. And actually, we, in terms of our generations, I'm gonna put myself in there with some of you younger folks, but we might be living to 95. So then you may need retirement income for 30 years. So let's just say that you would need $5,000 of monthly income. So you would want to have saved a little over $1 million in order to survive for that 30 years. And not only would you have that $1 million, you would need to be building interest on that as well. So when you start thinking about, wow, what type of lifestyle do I want to have when I retire? I'd say dream big and plan so that you can actually reach retirement and stay retirement and not be semi-retired or in other situation where people actually have to go back to work because they don't have enough money. Right now in America, the average retired individual has about $40,000 to live off of for their retirement. So as you can see, even with a monthly income need of $1,000, they still don't have enough. And that's often why individuals have to go back to work even after their retirement. Another thing that we want to be able to do with our investments is to create generational wealth, and particularly for those who have children and families. You want to build up your investments so that you can actually live off the interest from the investments and not the principal. So if you have, let's say, $1 million and you have, just for example purposes, again, a 10% interest rate, so then you're living off that $100,000 and you never have to touch that principal. Then you take the principal and you pass that on to your children with instructions to, again, live off the interest and continue to build the principal. So you always have this millionaire family because you're never touching that principal. And also have life insurance in case you transition before you have built up your investments. And teach your children, again, not to go crazy and buy cars and all kinds of other things with that insurance, but really to start planning for their futures as well. So we are coming to the end of my talk, and I think I'm leaving you guys a few minutes for questions, but key takeaways are: prioritize financial education. Make sure you correct your W-4 annually, or when your lifestyle changes, such as when you get married or have additional children, or that you move to a different home, or you start a business, which I have planted that seed that is something you will consider. You want to reduce wasteful spending. Consider increasing your income by opening a home-based business, and start planning for your retirement yesterday. Ignorance isn't bliss. Ignorance is poverty. Jim Rohn. So a couple different resources that may be helpful to you. I am truly an advocate of reading, but if you are like me and you're busy, sometimes you have to listen. So just sharing this from Audible. Here's different books that I would recommend at some point in time you start reading. Even though Rich Dad, Poor Dad is probably the most popular, my favorite of Robert Kiyosaki is The Unfair Advantage. And it just talks about how having financial literacy really puts you at an advantage in the world. Some other books that I highly recommend are Sandy Botkin's Lower Your Taxes Big Time, where he indicates that most people are paying about $9,000 too much in taxes, well, most families, just because they don't understand the power of a home-based business and actually how to lower taxes. Another great resource is the 475 tax deductions for businesses and self-employed individuals. And another great one as it relates to insurance, and I know I didn't go into that too much, is what would the Rockefellers do? So let's go ahead and open it for questions. My website is dryaz.myecon.net, and that is with the business that I am affiliated with. And you can also reach me by email at ynkrumahellie@gmail.com. So if anyone has any questions, feel free to ask.
I was wondering if you could talk a little bit about how, the notion of home-based business and transitioning those things to assets, how the standard deduction factors in there in terms of what you can claim. Like, are you itemizing at that point?
Yes, you are itemizing. So for business owners, you are usually itemizing. Of course, there's some really great calculators to see if the deductions that you're calculating would recommend that you itemize versus take the standard deduction. But for me, ever since I learned about financial literacy, and even with the changes that we've seen in 2008 and now, in 2021, still itemizing, just because there's so many additional deductions that I receive, more so than that, $12,600 per year for the standard deduction. So in that example that I gave, 20,000, right? Versus just taking the 12. So I'd say if you can, go through the calculators, but itemizing often will be better. And you want to make sure that you have a great tax professional that is very familiar with home-based businesses to be able to give you advice.
Yeah.
Did that answer your question?
Yes, it does.
Awesome.
Yeah, I guess obviously depends how you're filing individually or as a couple. You get up to like 2,500. But yeah, those are great tips.
Right.
Thank you.
No problem.
So my question is, if you hire your kids, how do you prevent them from unionizing?
Well, you're their employer. And they're under 18. So, when you do hire your children, you actually create a contract, so a legal binding contract, and you sign it both as their employer and as their parent, right? So you can pay them up to that taxable amount, which we were just talking about, of $12,600. And so you might pay them that, but you might pull out their retirement, and you're putting, that into Roths and things of that nature as well, or, into educational plans. So there's a lot of great solutions for how you can save money through your children. And you can pay them as early as 2 months of age, or as soon as they have a Social Security number. So my first job was technically when I was 6 weeks old, and I was in my very first commercial.
Thank you for those. That's just fascinating to think of all the ways that you can, all of the policies and procedures and things that are in place that you can take advantage of if you know about them.
Right. And most people don't know. Even with it coming to hiring your kids, you can hire them as an apprentice for whatever your business is at age 7 for most states. So it's pretty amazing. So I definitely say grab those books. Those resources are very helpful, and make sure you keep them in your library. And as they are updated, get the new versions too, just as our tax laws continue to change. All right, any other questions?
A question about the consultancy. Where can you find those jobs as a side hustle?
So if you're starting your own consultancy, you find it within yourself. And so you decide, I'm going to be a consultant, and I'm going to register my business within the state. Colorado's laws for starting a business are beautiful and easy, whereas in some other states, they can be a lot more challenging. But just being able to go to the state of Colorado website and being able to file and register your business, you typically can do all of it within a day, whereas in some other places, it may take weeks to be able to complete that. So you can start it that way. And now if you're trying to be a consultant for another business, that's something that you could also do. And you may make a 1099 or have a 1099 versus a W-2. 1099 is going to be for that employer, that contractor, versus actually being an employee. And so you can reach out to different organizations and see if they need a consultant. If you want to get hired as a consultant, you often, find those types of positions similar to where you would find any other job. And then, when you go for your interviews, you'll ask, will I be an employee of this company, or will I actually be an external consultant? And it's very surprising to see how many more companies are hiring consultants to do work, which might include lab work or things of that nature, versus actually hiring employees. One of the differences, as a consultant, you have a lot more control in terms of the work that you're actually doing, versus the employer saying, this is what you have to do by this period of time. You have more negotiating power in that space. Did that answer your question? Okay, great. And you can hire yourself as a consultant today and be an expert in whatever you are an expert in. It gets a little challenging when you have to market yourself, but once you get over those hurdles and you get comfortable with it, it's a great process. All right, well, I feel like I have used my time. Feel free to reach out to me if you have any questions. Reach out to me on LinkedIn, Yasmeen Nkrumah-Elie, or the information I provided earlier. And I look forward to seeing all of you at the top of the wealth mountain.
All right. Thank you, Yasmeen.
Thank you
very
for your
much.
time.
No problem.
All right.